Welcome back. So in the earlier videos, we talked about debt, we talked about interest cover. The next factor which I take into consideration while doing my quick risk check is if the business requires too much of capital to run the business. And as a result, if the free cash flow is depressed, I have a preference for businesses which generate a lot of free cash flow. So for me, I would not necessarily say that this is a risk, but it's just a question of preference. Taking this factor into consideration, I'm able to eliminate a lot of business ideas. So let's take the example of this Malaysian company called Riverstone Holdings. It's listed in the Singapore Stock Exchange. They're in the business of making latex and nitrile gloves for healthcare and the clean room industry, the high-tech manufacturing industry. Now, I intentionally wanted to show you this example because this is actually a well-run company. I have a lot of respect for the management of this company. The company is doing very well. And as you can see from this picture, the revenues have been steadily growing. Now, there was a point of time when I used to hold some shares, a small position in this company, but I have subsequently exited the position. This is purely for disclosure's sake. Now, while the company has been growing steadily and even the operating cash flows show an upward trend, you will realize that the company requires a lot of capital expenditure. Now, to manufacture these gloves, they have to set up their factories, right? And as per the last report, their current capacity is, I think, just above 9 billion gloves. Now think about it. The more they grow, the more manufacturing facilities they have to set up. So their capital expenditure is kind of a never-ending story. And because of that, see what happens to their free cash flows. It's very erratic. So, one might argue, the people who like this company, they might argue that, hey, they're reinvesting in the business and the returns they're getting from the invested capital is actually quite high, which is true. I mean, their return on invested capital hovers around 20%, which is great, but it's just that my preference is for companies which do not require too much capital to run. For example, look at this company, 51 Job. It's an online recruitment service based out of China. They own the largest job site in China, and they also provide other human resource services to small and medium companies. Now, not only their cash from operations, the cash flow generated from operating activities, not only that's showing a solid growth, even their free cash flow is growing a lot. Why? Because the company hardly needs any capital to run the business. As the company grows, they're actually throwing out capital. So their free cash flow keeps growing. So these are the kind of businesses which I really like. Now, having said that, this is not a recommendation. And I think it's appropriate that I put in a disclaimer here. I will be discussing a lot of these short case studies in this video series. Now, they're purely for educational purposes, and they're just to highlight the example. They're just to highlight the process that I follow to eliminate most of the ideas, my quick risk check process. That doesn't mean that I'm recommending any of these businesses.